Okay, so we're going to start chapter 3, the adjusting process. And our learning objectives to differentiate between cash basis accounting and accrual basis accounting, define and apply the time period concept, revenue recognition and matching principles, explain the purpose of and journalize and post our entries, our adjusting entries, explain the purpose of and prepare an adjusted trial balance, identify the impact of adjusting entries on the financial statements, explain the purpose of a worksheet and use it to prepare adjusting entries and the adjusted trial balance, understand the alternative treatments of recording deferred expenses and deferred revenues. So first we're going to differentiate between cash basis accounting and accrual basis accounting. And we are on page 118 in your book. So cash basis accounting, I normally will say it's kind of like how most people account for their personal money. We get cash, we spend it. That's just how it is. Revenue is recorded when cash is received. So as soon as we get our money, we record in our minds, we acknowledge that we have this cash. And then expenses are recorded when the cash is paid. So then we go and we buy $50 in gas. Now we know that we're less $50 because we spent money on gas. Cash basis accounting is not allowed under GAAP. So GAAP only allows accrual basis accounting, and in accrual basis accounting, revenue is recorded when it's earned. So we talked about earlier unearned revenue and how we still have to record that we have this revenue, but we haven't earned it yet. So we're going to put it in an unearned revenue account because we're still required to show that. That is part of accrual basis. So revenue is recorded when it's earned. So once we've earned that revenue, then we will put it into our revenue account. Expenses are recorded when they are incurred. When we have an expense, we record it when it's incurred. And accrual basis accounting is what is used by most businesses. So most businesses use accrual basis accounting. And just make sure that you remember that cash basis is not allowed under GAAP, and most businesses use accrual basis accounting. Next, we're going to define and apply the time period concept, revenue recognition, and matching principles. So the time period concept, business activities are sliced into small time segments, and financial statements can be prepared monthly, quarterly, or annually. A fiscal year, 12-month period. So make sure that you know that. A fiscal year is any 12-month period in accounting. So most companies use January to December as their fiscal year, but there are several companies, there's a lot of companies out there that don't. I've worked with a company that went from July to June or February to January. So there are companies that don't go by January to December. And there's a number of reasons that could be. I think maybe one of the most common ones is just when the business started. So a lot of people don't wait until January to start their business. So let's say you started a business in May. Well, you can choose to either make your fiscal year January to December and only show revenue from, let's say you start all your expenses and everything, like your business starts in May, everything starts in May for simplicity purposes. If you choose to, you can either choose for your fiscal year to be January to December and just show that you had no revenue in those first couple of months because you had no business. Or some businesses say, hey, I want to start this, I want my fiscal year to start when my doors opened. So my fiscal year will be May until April of next year. So that's one thing. Another one is the type of business. So a lot of schools, school starts in August for most schools and ends in May. Well, a lot of schools, their fiscal years are July to June, or maybe even August, but normally it's July to June. So it just depends on the type of business as well. It often coincides with a calendar year. That means that it often is January to December. However, there are some cases where it's not. The revenue recognition principle. This dictates when to record revenue and the amount of revenue to record. Revenue is recorded when it is earned. It can be different from cash collections. And revenue is based on the actual selling price of the item or service. So for example, we have a t-shirt that we're selling for $20, but if you buy it today, I'll sell it to you for $15. Revenue would be $20, and then we would have a discount account to record the other $5, and the customer would pay us $15 cash. So this is just saying when you do, revenue is based on the actual selling price. So if our sales price is $20, that's what we're going to put in our revenue account, regardless of anything else. If we have a discount, we put it in a discount account, but revenue will show $20. And in that example, that means that our cash collections would also be different, right? Because we said that we have a shirt that we're selling for $20. So $20 would be our revenue. But if they buy it today, we'll give them $5 off. So we're going to give them a discount of $5. That means that the cash they're going to give us is $15. So this still equals $20. But the shirt, we're recording revenue at $20. The cash account is getting $15. And so we just have this discount we have to record of $5. So that's what we're saying here. So when we recognize revenue, we're sometimes it will be different from our cash collections, and just making sure that it's always based on the sales price, and we record it when it's earned. So we'd record it, if we sold it today, we would record it today. The date that we put on our books would be January 27th. So this is just a picture of revenue recognition principle. Same thing. So we're saying revenue should be recorded when it is earned. And to determine that, a good has been delivered or a service has been performed. So in this example, we delivered the shirt, or if it's a service, we provided the services that they requested of us. So if they requested us to cut their grass, we cut their grass, so we have earned this revenue. So we will record it because we performed that service. And then the earnings process is complete. So the matching principle, this is on page 121. The matching principle guides accounting for expenses. So expenses are recorded when they are incurred. during the time period, and expenses are matched against the revenue of the period. So for example, when we record rent expense for January, we record it against our January revenues, even if the rent was paid in December. So sometimes people you have your rent is due January 1st, but they go ahead and they write the check on December 31st and send it off to pay their rent. Well, this example is telling us that even if the rent was paid in December, we paid it in December, we wrote the check for December 31st, but it was for January's rent. We're going to record that rent expense for January in January's revenue, against January's revenues. So it's going to go against the period that it is incurred. Explain the purpose of and journalize and post adjusting entries. So what are adjusting entries and how do we record them? So we've been talking about adjusting entries and we've gone through some examples when we're discussing our assessments. This is an example of the unadjusted trial balance. The unadjusted trial balance comes from the general ledger, and adjustments are needed due to the time period concept, revenue recognition principle, and the matching principle. So on page 122, you'll see this here. So this is a picture of the unadjusted trial balance, and we have all of the accounts. Remember, we mentioned balance sheet accounts at the top, income statement accounts at the bottom, but all of those are found on our unadjusted trial balance. And then here we are seeing some types of adjusting journal entries. So adjusting entries can be divided into two basic categories. We have deferrals and accruals. Deferrals are deferred expenses and deferred revenues. Accruals are accrued expenses and accrued revenues. Deferred expenses, these are advance payments of future expenses. They're treated as assets until they're used. And they're recognized as an expense by an adjusting journal entry when the prepayment is used. And so this is on page 123. We're going to go through some examples. But advance payments of future expenses. So this is where we paid something early that we know we're going to have to pay later. So a lot of times the most common one you would see is probably like rent. So we paid our rent early. So we paid it on December 31st, but it wasn't due until January 1st. So it's deferred until it's due. Types of deferred expenses: prepaid rent, office supplies, and depreciation. So on the bottom of 123, it says, in Chapter 2, we went through several transactions, and they're telling us, remember in Transaction 10 in Chapter 2, Smart Touch Learning prepaid 3 months of office rent of $3,000. $1,000 per month times 3 months on December 1st, 2016. So the entry to record the payment, we debited our prepaid rent by $3,000 and we credited cash by $3,000. This is to show that the cash went out, we paid out $3,000, and we prepaid our rent $3,000. The T account, to show that in our T account, we would debit our prepaid rent by $3,000. And remember, we put the date next to it. So I know y'all have T accounts that you're working on. So just make sure that whenever the transaction occurred, you put that date next to it. So to adjust our prepaid rent account, flip the page. So throughout December, prepaid rent maintained its balance, but $3,000 is not the amount of prepaid rent for the balance sheet at the end of the year. And that's because as of 3/31, prepaid rent should be decreased for the amount that was used up. So we're going to take the used up portion, which is 1 month of the 3 months prepaid, so 1/3. And we're going to create an adjusting entry to show the transfer of the $1,000 from prepaid rent to rent expense. And so this is what our adjusting entry would look like. So we're going to debit rent expense because now it's being expensed. So we're debiting rent expense for $1,000, and we're going to credit prepaid rent to reduce the amount of prepaid rent that we have by $1,000 because we've now used that $1,000 and expensed it in this month. And our note is going to be to record rent expense. To see how that affects the T account, so on December 1st, we had $3,000 sitting in our prepaid rent account. But then at the end of December 31st, we expense 1 month rent, so $1,000. So that leaves us with a balance of $2,000 now sitting in our T account for prepaid rent. Well, something has to happen somewhere else with this $1,000. So we've expensed this amount for rent, so it's going to affect our rent expense account. So in our rent expense, we already had $2,000 sitting there from November 15th. We're going to take $1,000 that we're now expensing, and we're going to put it in our rent expense account. So now our total rent expense is $3,000. So there's always at least 2 accounts that are affected by a transaction. Then on November 3rd, we're looking at office supplies. So on November 3rd, we purchased $500 of office supplies on account, and then there was an unadjusted trial balance. We had office supplies listed at $500, but Smart Touch Learning's December 31st balance sheet should not report those office supplies. Hold on. Let's see. Let's read this whole little example. So it says office supplies are also accounted for as a prepaid expense. Looking at another example, on November 3rd, Smart Touch Learning purchased $500 of office supplies on account. So we bought $500 of office supplies on account. Then on December 31st, our unadjusted trial balance therefore still lists those office supplies with $500 debit balance, but Smart Touch Learning's December 31st balance sheet should not report the office supplies of $500. Why not? During November and December, the e-learning company used office supplies to conduct business. So the cost of the supplies that was used now becomes a supplies expense. To measure the supplies expense, the business first counts the office supplies on hand at the end of December. This is the amount of the assets still owed by the business. Assume that the office supplies cost $100 remains on December 31st. Then the business uses the office supplies T account to determine the value of the supplies that were used. So in our book on page 125, we see the office supplies T account. We have a debit of $500 from November 3rd, where we had $500 in office supplies. But then it said that we now we have a remaining amount of 100 on hand. So our balance is going to be 100. So we see that in the bottom. So we just need to figure out, well, then how much did we use? Well, if we started with 500 and now we have 100, the difference of those is 400. So 400 is what we used. And so we would credit the T account where they have that little question mark in your book by $400. And then the journal entry. So now we figured out how much we used. So for our journal entry, we're going to debit supplies expense because we're going to expense those supplies that we used of 400. And we're going to reduce our office supplies account by 400. So office supplies is going to get credited 400. And then our note is to record office supplies used. Depreciation, the bottom of 125, and then it continues on to 126. Plant assets. So plant assets are long-lived, tangible assets. They're used in the operations of the business. Their value and usefulness declines as the assets are used. Similar to deferred expenses, they are paid for when acquired. They are used up over time, and usage is recorded as a depreciation expense. So here we have, let's see here. All right, so going on back to December 2nd. December 2nd, we received a contribution of furniture with a market value of $18,000 from Sheena Bright. We received this last week in Chapter 2. In exchange, we issued shares of stock to Sheena Bright, and we made this journal entry. So she gave us furniture, so we're going to debit our furniture account by $18,000 to increase it. And we gave her common stock for the value of the furniture. So we're going to credit our common stock account for $18,000. And in our note, we're saying that we had a contribution of furniture in exchange for common stock. Depreciation is the allocation of a plant's assets cost over its useful life. We're going to depreciate this furniture. So depreciation is the allocation of a plant's assets cost over its useful life. So for example, you have a phone, you paid, phones are expensive. You paid $500 for this phone. Well, it's not worth $500 after you buy it. And a year from then, it's not going to be worth $500, right? It's going to be worth less than that. Even if you don't use it, let's say you keep it in the box and you never use it, you're still not going to be able to get $500 for it probably, because there's a new phone, there's a better phone, there's, so assets depreciate. So that's just an example of depreciation. And like normally you'll put a number on it. You'll say, okay, this phone I think will last me 5 years. Okay. So if you think this phone's going to last you 5 years, your depreciation will be over a 5-year period. And at the end of 5 years, you're saying the value of your phone is going to be 0. At that point, nobody's going to buy it. I'm probably just going to toss it, throw it away or something, donate it for parts. So that's what depreciation is. So it's the allocation of a plant's assets cost over its useful life. And useful life was the 5 years that I had just mentioned for the phone. We thought that it had a useful life of 5 years. So all plant assets are depreciated with the exception of land. Every plant asset is depreciated except for land. Residual value is the expected value of a depreciable asset at the end of its life. So when we were talking about the phone just a second ago, we said, I said the residual value was 0. At the end of the 5 years, I think there's going to be no value on my phone at all, and I'm just going to throw it away. It's not going to be worth anything. But let's say that at the end of 5 years, we thought we could probably still sell it for $100. Well, then the residual value for that phone is $100, saying that after we depreciate this phone over this 5-year period, we think that we can probably still get $500 for it. So that's residual value. The straight line method allocates an equal amount of depreciation each year. So with the straight line method, with the phone, we said, okay, we paid $500 for the phone. We expect the residual value to be 0. We don't expect to get anything from it at the end of this period. We think this phone will last us 5 years. So with the straight line method, we would take the $500 for the phone, divide it by 5 years, and we would have 0 at the end. So that's the straight line method. That's how you would calculate it. And you'll see it. We'll have examples in here. I think it's the very next slide, actually. Let's see. Yeah. So in this example, we're using the straight line method to calculate $300 of depreciation. And so we're saying that the cost of the furniture is $18,000. And we don't expect to get anything for it at the end of the useful life of this furniture. We think that after 5 years, we're saying that this furniture will last us 5 years. And we're saying that after 5 years, we are not going to be able to sell this. Maybe it's like, couches and they're cloth, and we think that there's just going to be maybe a lot of wear and tear. Maybe, we have, I don't know. But anyways, we don't think we're going to get anything for it. We're not going to be able to sell it. So we're taking the cost of $18,000. We're going to subtract out whatever residual value we think we're going to get at the end. In this case, 0. And then we're going to divide this by the useful life, which we said was 5 years. So we have $3,600 per year in depreciation based on the straight line method. And you're going to have to calculate this. So, so make sure that you know this or where to go to find this formula, which is on page 126 in the book and slide 22. So we say that we've calculated our annual depreciation is $3,600 because we divided it by 5 years. This is our annual depreciation, $3,600 a year. Well, we want to know what it is monthly. So we're going to take this $3,600 per year and divide it by 12 months. And that tells us that our monthly depreciation on our furniture is $300 a month. So every month, we're going to depreciate our furniture by $300. Recording the entry, page 127. So recording the entry requires 2 accounts. You are using your depreciation expense account because we're expensing depreciation, and we're also going to affect our accumulated depreciation account. So on December 31st, we're going to debit depreciation expense for furniture, $300. And we're going to credit accumulated depreciation for furniture by $300. And then we're going to make a note that says to record depreciation on furniture. The accumulated depreciation account is the sum of all depreciation expense recorded for the depreciable asset to date. So this is all of the depreciation that we've recorded on the furniture up to now. Accumulated depreciation is a contra account. Therefore, the account balance is the opposite of the normal balance of the related asset. The cost minus accumulated depreciation of a plant asset is called the book value. So we paid $18,000 for the furniture. That was the cost. We gave stock, but that's the cost of it. So $18,000 for the cost. We're going to subtract out the $300 for the accumulated depreciation. Let's just say we've only depreciated it once. Then the difference of that would be the book value recorded on that following month. This is on page 129. So plant assets on the balance sheet. This is our balance sheet, and we're just looking over some of our plant assets. We have furniture, we have a building, we also have land. Furniture, we have a value of $18,000. That's what we received it as, but we're having to also record our accumulated depreciation. We calculated it as $300. So we're going to take out the accumulated depreciation of $300, and that's going to give us a total of $17,700 currently in our furniture. Our building, we had $60,000 less accumulated depreciation on the building, which we say is $250. So now our building is at $59,750. Our land, we're going to not depreciate it because land does not depreciate. So our land is at $20,000. There's no depreciation expense here. We're going to add all of these up to get our total plant assets, which is $97,450. Deferred revenue. Deferred revenue. Yes, ma'am.
I have a question. So, is there somewhere specifically that we have to record until when we have to depreciate that asset? But how do you remember until when you have to keep subtracting that, like every month?
So if it's a question on any of your homework or quizzes, it'll tell you. In real life, you would depreciate it monthly. Some, depending on what it is. If it's a small company, some companies may only record their depreciation once a year, but most companies record it monthly because they report all of their statements monthly. But some of them I have seen, they'll just true everything up at the end of the year. It's called truing it up, where they're bringing it, kind of like when you're going through your adjusting for your trial balance. You're just bringing everything current, so you're truing it up to what it really is. But normally it's monthly.
But there's not a specific document where you have all of these things just to remember that you have to do that depreciation like every month until when.
You can create one, like yourself.
Something that has an official name.
Not like a report. But you can create one if you like for personal use. I mean, I have one. It's called a monthly closing checklist. But there's not, like, for the purposes of this, there's not a report like balance sheet, income statement, stuff like that has all that on there to tell you when to record it. But depreciation, when you decide that you are going to depreciate an asset, you start depreciating it when you receive it, like from the moment that you receive it. So like the furniture, We received the furniture in December, I believe. Let me go back. I don't want to. I know we put it in here. We received the furniture in December, on December 2nd. And so at the end of December, on December 31st, we depreciated that 1 month of furniture by 1 month of depreciation. And we're going to continue to do that every month until it's fully depreciated. And fully depreciated just means that we have gotten down to our residual value. In this case, we said 0. So once we get it down to 0, or our accumulated depreciation on furniture is $18,000, then we fully depreciated that asset.
And about the residual value, where do you get that from?
So that is really based on you, like I would say you, but management. So management decides how long they think a particular asset will last and what the value of that asset will be, and they base it off of it's supposed to be a very good, like, educated guess. So it's supposed to be based off of other assets that are similar to that, maybe assets they've had in the past where there's this trend that we can normally sell our office chairs for $25 after we're done using them. So we're going to say we can sell our residual value on our office chairs $25. We think we'll be able to sell it. And we normally buy new office chairs every 5 years. So we're going to say that this office chair will last us 5 years, and at the end of 5 years, we're going to be able to sell it for $25. Now, that doesn't necessarily mean that's going to be true, right? I mean, what if the chair breaks? But for the most part, for depreciation purposes, that's what we're doing. Because things happen. I mean, cars depreciate, but if you have a car wreck, So there are other things that can happen, but it's all supposed to be based on educated guesses. And if you definitely want it to be close to a good, like, you can't depreciate something outrageously. Like, you shouldn't buy a car and depreciate it in the same year, because the car should last you longer than a year. So just trying to make an educated guess, but it's really based on management, whoever the higher ups are that specialize in those types of fields.
Thank you.
No problem. Deferred revenue. Deferred revenue occurs when a company receives cash before they do the work or deliver the product. It's a liability because the business owner owes the customer the product, the service, or a refund. So they gave us this money. We have $100 in our hand right now, but we have not earned it. Therefore, we might owe it back to them, so it's considered a liability. And then once we perform or deliver the service or the work, then the deferred revenue is converted to earned revenue. So now we've performed the work, we've earned this $100, so now it's converted over to earned revenue. And this is on page 129. So we see here on December 21st, a law firm engaged Smart Touch Learning to provide e-learning services for the next 30 days, and they paid $600 in advance. So we're going to debit our cash account $600, credit unearned revenue, and our note is that we collected cash for future services. So our T account for unearned revenue, we're going to credit unearned revenue on December 21st for that $600. And then during the last 10 days of the month, we performed 1/3 of the services. This is on the next page. So we performed 1/3 of the services, meaning that we have now earned that. So we are going to debit unearned revenue to take it out of unearned revenue because now we've earned it. And we're going to credit service revenue, the $200, to show that we have now earned this revenue. And this is a good example to refer to when you're working on your assessment. If you're working on requirement 3, your journal entries, I would go back to slide 28, the slides around here. And this is also on page 130. Go back to here. Okay. So down here we see our T accounts. We have unearned revenue of $200 that we're debiting, and that's just to take it out of our unearned revenue account. So now the amount of revenue that is left unearned at the end of December 31st, we still have not earned $400. And then for service revenue, we have, these are from the last week, but we have the 5,500 service revenue, 3,000 service revenue, and then on December 28th, we had 8,000 service revenue. We are recording a third of these services that we have earned. So now we have this 200 that we've earned. So we're going to credit service revenue for that 200. And so now our total service revenue that we have earned so far is $16,700. Accrued expenses. Accrued expenses are expenses a business has incurred, but it has not yet paid. Examples of accrued expenses, you have salaries, interest, utilities. And so here we're paying our employees a monthly salary of $2,400. Half of it we pay on the 15th, and the other half we pay on the first day of the next month. So accrued salaries expense. On December 31st, Smart Touch Learning owes its employees $1,200, which won't be paid until January 1st. So we're going to accrue salaries for December. So on December 31st, we had the salaries expense of $1,200, but we didn't pay it yet. So we have a salaries payable of $1,200. And that's a liability. We owe it. Sitting on our books, we owe this money. So our T account, we are going to credit salaries payable for $1,200, and we're going to debit salaries expense for $1,200. Accrued interest expense. So we borrowed $60,000 on December 1st to purchase a building. And then on December 31st, we incur $100 of interest on the note. So we are going to debit our interest expense by $100, and we are going to credit our interest payable by $100, and then our note is to accrue interest expense. Accrued revenues arise when a company performs a service but has not yet collected the cash. A company delivers a product, but they have not collected the cash. We record accrued revenues with a debit to accounts receivable and a credit to service revenue. So we have on December 15th, we've agreed to perform e-learning services for $1,600 per month by the end of December. and we've earned half of the monthly fee. So half of 1,600 is 800. We're going to debit our accounts receivable account for 800. We're going to credit our service revenue account for 800. And this is to accrue our service revenue. And this is on page 134. They also show the T accounts as well. So here in Exhibit 3-3, we are looking at all of the entries. So we've got deferrals, which are cash receipt or cash payment. These occur first. So in this original entry, we had a prepaid expense. So we debited our prepaid rent and we credited our cash account. And the note was to pay for rent in advance and record an asset. And this is a good place to go as well when you're working on your adjusting entries in your assessment. Because these are some good examples here, and they're showing what the original entry would look like and then what the adjusting entry would look like as well. So in this original entry, we debited prepaid rent and credited cash. But then when we went and we made our adjusting entry, we debited rent expense and credited prepaid rent. So notice we're not using the two same accounts, right? In this first one, prepaid expenses, we debit prepaid rent and credit cash. When we adjust it, we're not using prepaid rent and cash again. Cash is no longer affected because it's only affected that one time. However, prepaid rent is going to be affected because now we're taking it out and we're putting it into our expense account. So prepaid rent and rent expense are the two accounts that are affected when we adjust. So just make note of that. The adjusting entries do not ever involve the cash account. Cash account does not happen in an adjusting entry. And you will probably notice that on your assessment when you're bringing in some of your adjustment information, cash does not change. The cash amount stays the same on your assessment because adjusting entries never involve the cash account. Adjusting entries either increase a revenue account or they increase an expense account, or they can, so you would either credit revenue or debit expense in an adjusting entry. Credit revenue, debit expense. So when you're doing your assessment and you have something that deals with revenue, remember you're crediting revenue, or if you have something that deals with expense, you're debiting expense. For depreciation, we have our furniture. In our original entry on depreciation, we debited our furniture and we credited cash. But then when we went in to adjust it for the depreciation, you have a question like this too, I believe. When we went in to adjust our depreciation for our furniture, we debited our depreciation expense and we credit accumulated depreciation. So if you notice here, those two accounts are different from the two initial accounts that we recorded, right? So in our first example, we used prepaid rent twice. We debited it in the first original entry, but then we credited it in the adjusting entry. When we're looking at depreciation, it's different. We debit our furniture account and credit cash to show the initial receipt of the furniture. But then when we're recording depreciation, the two accounts that are affected are depreciation expense and accumulated depreciation. So when you're working on your assessment, make sure that you're affecting the depreciation expense and the accumulated depreciation. And then for unearned revenues, our original entry for unearned revenue was debit to cash and credit to unearned revenue. But then once we earned the revenue, we had to make an adjustment. The adjustment is debit unearned revenue, credit service revenue, because now we've earned some revenue. So you'll notice here with our unearned revenues, we do use unearned revenue twice. It's in our original transaction, and then it's also in our adjusting entry as well. And then it shows down here at the bottom in the circle, 2 rules to remember about adjusting entries. Adjusting entries never involve the cash account. You don't see cash over here on the right-hand side when we're looking at these entries. Adjusting entries either increase a revenue account, credit revenue, or they increase an expense account, debit expense. And then we have here accrued expenses. We're going to debit. So when we have cash receipt or cash payment that occurs later, we are going and it's an accrued expense. We're going to debit salaries expense and we're going to credit salaries payable. If it's an accrued expense, debit salaries expense, debit salaries payable. Credit salaries payable, and that's to accrue for our expense that was incurred. If we have accrued revenues, we're going to debit accounts receivable and credit service revenue, and that's the accrual for revenue that was earned first. So in this exhibit, this shows, it summarizes different entries that we've gone through. So we're going through A and D. Let's see here if this is, it's larger in your book. It's on page 136. And so this is showing that the adjusting entries and accounting balances after posting are shown down here in this area. And panel A gives the data for each adjustment. So this is panel A, right? Can you see my pointer? Let's do this. Okay, now, so this is panel A. So panel A is given the data for each adjustment. And then panel B right here, this says panel B. So all of this is showing the adjusting entries. And then panel C, panel C is on the next page. Panel C is then showing the T accounts. So if you want to see what the T accounts look like and how the adjusting entries affected the T accounts, maybe use that while you're working on your T accounts as well in the assessment. That's on page 137. But these are all the journal entries that we just went over. They're just all combined in one location. So you can look at all of them. So if you wanted to have a page to go back to, I would probably refer back to 136 and 137 when working on your assessment. And then if you need more detail than what you see here, flipping back a couple of pages and actually looking at the individual entries. Y'all want a 5-minute break? Okay. So we'll come back at 10:40. we are, let's see here. All right, so learning objective 3.4. Explain the purpose of and prepare an adjusted trial balance. So we have the adjusted trial balance. First, we are journalizing the adjusting entries. Then, sorry, it's asking me to sign back in. Just 1 second. Okay. It kicked me out of Moodle for some reason over here on this one. So first, in the adjusted trial balance, we're going to journalize our adjusting entries. Then we're going to post the adjusting entries. And then we're going to prepare an adjusted trial balance. So at the end of the fiscal period, an adjusted trial balance is prepared. We have a summary of all accounts with adjusted balances. And the purpose is to ensure that our total debits equal our total credits. And this is on page 139. So we have here a copy of our adjusted trial balance. The adjusted trial balance includes the balances after we post the adjusting journal entries. We prepare the financial statements from the adjusted trial balance. So if you recall, I mentioned with your assessment, once you complete requirement 2, where we took our unadjusted trial balance, we added in all of our adjustments for the period. We then found what our adjusted trial balance was. We are going to create our income statement and our balance sheet directly from our adjusted trial balance. And then on requirement 4, we're just showing our adjusted trial balance. So we're just copying over our adjusted trial balance. And from that adjusted trial balance, we are completing requirement 5, the income statement. We're then going to be able to we will then be able to complete our statement of retained earnings. And then we will be able to create our balance sheet from our adjusted trial balance. So we're going to identify the impact of adjusting entries on our financial statements, because we just said that we create our financial statements from our adjusted trial balance, and our adjusted trial balance is based off of our adjustments. So we're going to look at the impact of these adjustments and how they impact our financial statements. The adjusted trial balance is used to confirm that our debits equal credits after we adjust our entries, and ensure balance sheet items are properly valued. Failing to record an adjusting entry results in incorrect financial statements. This is on page 141. The impact of adjusting entries on financial statements. So here we are looking at, we have the type of adjusting entry. So we mentioned earlier that the different types of adjusting entries, we have deferred expenses, we have deferrals and accruals, right? We have deferrals and we have accruals. And then within deferrals, we have deferred revenues and we have deferred expenses. Within accruals, we have accrued revenues and accrued expenses. So this is breaking down all 4 of those for us. So deferred expenses, this is an advance cash payment of a future expense. Deferred expenses, the adjusting entry for a deferred expense is you would debit expense and credit the asset. And the impact on the financial statement, if the adjusting entry is not made, your income statement would show your expenses would be understated, meaning that they would be shown as lower than what they are, and your net income would be overstated, showing that you made more income than you actually did. On your balance sheet, your assets would be overstated and your equity would be overstated. For deferred revenues, advance cash receipts of future revenues. So the adjusting entry for a deferred revenue, you would debit liability and credit revenue. For deferred revenues, if you did not make the adjusting entry, it would show on your income statement your revenues would be understated if you did not record your deferred revenue. And your net income would also be understated as well. Your balance sheet, if you did not record your deferred revenues, your balance sheet liabilities would be overstated. So it would show that you owe more money out than you really do. Your equity would be understated. Accrued expenses, an expense that has been incurred but not paid. For accrued expenses, you would debit your expense and you would credit your liability. And for accrued expenses, your income statement expenses would be understated. Your net income would be overstated. For the balance sheet, liabilities would be understated and equity would be overstated. For accrued revenues, this is a revenue that has been earned, but cash has not yet been collected. So for accrued revenues, you're going to debit the asset and credit the revenue. Your income statement, your revenues would be understated and your net income would be understated if you failed to adjust for accrued revenues. Your balance sheet, your assets would be understated and your equity would be understated if you failed to report your accrued revenues, if you failed to adjust that. This is a good slide to go back to when working on your homework. I think you do have a question in there about this, about like how this would be affected. So if you go back to this slide, you'll be able to answer that question pretty easily. Slide 42. So the purpose of a worksheet. So this is our worksheet. This is a worksheet. And now we're talking about the purpose of a worksheet. So this is where we took our unadjusted trial balance, we brought in our adjustments, we adjusted our trial balance, and we're pulling over our income statement and our balance sheet accounts. This is just a worksheet that we have that we're pulling all that into. So the purpose of a worksheet and using it to prepare our adjusting entries and the adjusted trial balance. So a worksheet is an internal document that helps to summarize the data to prepare our financial statements. There are 4 sections in the worksheet. As we know, we have seen them in our assessment, but the 4 sections, we have the account names, the unadjusted trial balance, the adjustments, and the adjusted trial balance. This is an example of a partially completed worksheet. This is on page 142. So here they have their unadjusted trial balance. They brought in all of their adjustments, and they then calculated their adjusted trial balance. So in your book, does everybody have their book? Yeah? Okay, good. On page 143, I would like for you guys to try to complete the try it, number 10. I think this will help you with your assessment as well. So on 143, number 10.
What page?
Page 143, number 10. Actually, I'm going to give you a few minutes to look over it, and then I'm going to have you help me complete it by telling me what we're going to do, because it shouldn't take very long, because we've talked about this a lot. I think you'll do fine. And if you have questions, I mean, you can talk to each other. If you want to do that, you can. Does everybody have it? I'm gonna try to send this over here. Hang on. So this is page 143. I'll send this to you in an email actually. That way you have it. Let's see. This is chapter 3, page 143. Try it number 10. Let me see. Just continue to work on it for a minute. I'm actually going to upload it to Moodle so that I can pull it up on this screen and walk you through it. But that way you'll also have it on Moodle. Let's see. Okay, so it's on Moodle. So you see here when you go to week 3, chapter 3. Down here at the bottom it says chapter 3, page 143. Try it number 10. And I am going to, actually I probably should have done this.